Today's lesson is from chapter 15. It's problem 2B. Today I'm going to be sharing with you an Excel spreadsheet that I've made up for problem 15-2B. And at the top part of the spreadsheet, I've given you some notes that you need to know before you're able to work this particular problem. The notes are kind of lengthy, so I don't want to have to read them to you, but I want you to read these. So I'm going to post them with the videos so that you can see the notes in Cengage on the Excel, the notes in Excel for problem 15-2B. The notes are about accounting for equity investments. That's part of the notes. And I'm just going to scroll down here to the bottom because I feel like you can pull these up and read these notes. Make sure you understand the terms and read over these notes that I've given to you because they are important in helping you to figure out what to do in these problems. We're going to look at the first journal entry for chapter 15, problem 2B. And the journal entries in this problem are for trading investments. And what trading investments are is they can either be debt securities or equity securities. And what I mean by that is debt securities are where we purchase bonds in another company as an investment, or equity securities. And what I mean by equity securities are stocks that we purchase in another company as an investment. In the majority of the transactions that we're going to be doing, we're going to be looking at stock today that we are going to be calling an equity investment, and the type of stock that we are selling is going to be what we consider to be a trading security. And what trading securities means is basically we're going to be selling these stocks as trading equities, meaning that we're going to be selling them on a day-to-day basis. We're not planning to hold on to these stocks. They are not considered to be available for sale stocks. They're not considered to be bonds, so they're not held to maturity types of investments. These are trading investments that we bought solely to be able to trade, to increase the market price of the stocks that we're buying, hopefully to gain a profit off of the selling of the stocks, and get a market price increase off of those stocks. So on February 14th, what you did is you purchased 4,800 shares of Apollo stock, and you purchased this as a trading security. So that lets us know that this is a current asset that we're dealing with, because we have bought these securities to be able to trade them on a daily basis. We bought the stocks at a cost of $26 per share. Plus, we had to pay a brokerage commission. So the brokerage commission will be added to the cost of the stock to get the total amount of our investment. So on February 14th, when we create the journal entry, we would debit the investments in Apollo stock. The investments is a current asset since this is a trading security. And if we were preparing a balance sheet, which we're not at this time, but if we were, it would be located in the balance sheet assets section, current assets. Investments in pilot company, since it's an asset account, is increasing. We're going to take the number of shares that we've purchased, we're going to multiply it by the cost per share, and then we're going to add to that purchase price the brokerage commission. So that brings us to a total purchase price of $124,992. We would credit, of course, our cash account. On the second journal entry, we have purchased 2,300 shares of Air stock as a trading security, and we bought it at $19 a share, plus a brokerage commission of $92. This is very similar to the first transaction that we just talked about. These are still trading securities, so that means that we are planning, well, we don't know when we're going to sell them, but we could sell them at any time during the year. We're not holding these stocks for longer than a year. So these will be current types of assets. We're going to debit our investment in Air's company account for the amount of 2,300 shares of stock times the cost of $19 plus the broker's fee. The total amount of this comes up to $43,792. We will debit our investment account, which is an asset account, and we will credit our cash, which of course is an asset account. On the next transaction, June 1st, we sold 600 shares of the Apollo stock for $32 a share, less a $100 brokerage commission. So this time we're selling some of the shares of stock that we purchased on February 14th. We are not selling all the shares, we're only selling 600 of the shares that we had originally purchased. So when we sell stock, of course, we're going to receive cash off of that sale. The cash amount would be calculated by taking 600 shares that we sold times $32, that was the selling price of these shares of stock, less the brokerage commission. So notice this time when we're selling the stock, the brokerage commission is subtracted from the price of the sale, or the sales amount. That will give us an amount of $19,100 as cash that we're receiving off of the investment. Notice the investments account is credited. The investments account would be credited for the cost of the 600 shares that we sold. To find the cost of the 600 shares that we sold, we have to refer back to the February 14th transaction. We bought 4,800 shares of stock at a total price of $124,992. If we divide this $124,992 by the total shares, that will give us the cost of each share of stock. Then we would multiply that cost of each share of stock times the 600 shares that we sold to get the total amount that would be credited to the investment account. The investment account is credited to reduce the asset account because we have sold 600 shares. Because it cost us $15,624 and we sold it for more than what it cost us, the difference will be a gain on the sale of investment. Notice the gains are credited to the gain account. This is an actual gain account that has happened, so we create the gain account by crediting it. Gains will increase on the credit side. Since we sold this stock, we now have less shares than we started with. We now have 4,200 shares left over. So in the next transaction, when we're receiving an annual dividend of 20 cents per share on our Apollo Incorporated stock, we can only receive the dividends on the total amount of shares that we own at this time, because we sold 600 of the 4,800 we had originally purchased. The difference of 4,200 will be multiplied by 20 cents per share to get the cash amount that we would receive as the annual dividend on these stocks. Our dividend revenue account would be credited. This is a new account for this chapter, and dividend revenue, as it states, as a revenue account, it will increase on the credit side. So our dividend revenue is going up by $840, and our cash also went up in this transaction by $840. The reason that we buy stock from companies is we're hoping to receive dividends off of the stock. Dividends are our share in the company's net earnings. And if there are trading securities like we're talking about in this problem, when we receive dividends from the company that we bought the stock from, we will credit the account called dividend revenue. This dividend revenue would show up as other revenue on the income statement. So at the end of the year, when we prepare our financial statements, dividend revenue would be increasing the amount of our revenue on the income statement. And again, it goes in the other revenue section. On December the 31st, because we have bought stock as a trading investment, at the balance sheet date or at the financial statement date, we're going to have to adjust the trading securities to the fair market value. We do not record them at cost, but we will record them at the fair market value on the balance sheet date. So what we have to do is some research about what's happened with our transactions. Remember, we have bought two types of trading securities. One of those is Apollo stock, and the other one is Air stock. I'm going to start with Apollo stock first and tell you that you need to find the cost per share of stock. And so Apollo's stock cost $124,992. We divide it by 488 shares of stock, and that will give us a total cost per share of $26.04. That $124,992 came from this original transaction here. In other words, we had to know what the original cost per share of stock was at the balance sheet date. Our original cost per share of stock was $26.04. Again, it was $124,992 divided by the number of shares of stock that we had, which should be 4,800. So I think I've got a mistake there. Let me calculate that one more time. If we take the amount that we bought the stock for and we divide it by 4,800 shares, it will give us 2604. So right here, I need to change this to 4,800 because it's not going to make sense to you if I don't. There was a typing error in that. All right, so 2604 is the cost per share of stock. Again, it's 124,992 from the transaction that happened on February 14th. And we divide it by 4,800 shares. That'll give us this 2604. The Apollo stock's fair market value at the balance sheet date was given to us in the December 31st transaction. The fair market value has actually risen above what it cost us. So there's a difference between the fair market value and the cost, and that difference is $6.96. It's a gain in this situation because the fair market value of Apollo stock was more than what we purchased it for at the balance sheet date. So this gain is what we refer to as an unrealized gain. Unrealized means it hasn't happened yet because we haven't sold the stock. But in order for our stockholders to have a better idea of the value of the stock investment, we need to show this unrealized gain on our financial statements. To find the total amount of the unrealized gain, we take the unrealized gain per share of stock and we multiply that by the number of shares of stock owned at December 31st. And because we had sold 600 of the 4,800 we originally purchased, the number of shares that we own now is 4,200. So we would have to multiply 4,200 times 696, and that will give us the total amount of the unrealized gain for Apollo stock. But since we had bought two types of investments, one in Apollo stock, the other in Air stock, we need to take a look to see what happened to the Air stock, whether there was a gain or a loss on an unrealized gain or loss on the investment at the balance sheet date. So first of all, we need to determine what Air stock cost us. And so we're going to go to the original transaction where we bought the stock for $43,792. We're going to divide it by the number of shares of stock that we purchased to get a cost per share of stock of $19.04. The fair market value of the Air stock was given in the instructions to the December 31st transaction. The amount was $18.50 that was given. That's the fair market value of our stock. Notice this time our cost was more than the fair market value at the balance sheet date. So this time we have an unrealized loss. We find that by subtracting the market value from the cost of the stock, and that will give you 54 cents, which is an unrealized loss. Or in other words, our stock cost us more than its value at the balance sheet date. So there's an unrealized loss. It's unrealized because we haven't sold the stock, but what we're trying to do is value the stock as best that we can so that our financial statements reflect the true value of our investments. We're going to take the 54 cents per share and multiply it by the number of shares owned to get the total amount of the unrealized loss. So 54 cents would be multiplied by 2,300 shares that we own of Apollo stock, and that will give us a total unrealized loss of $12.42. Now, because we own two types of stock, one of the stocks had an unrealized gain and the other one had an unrealized loss, we're going to combine the unrealized gain with the unrealized loss. Because our unrealized gain was larger than our unrealized loss, the combination amount means that we have an overall unrealized gain on our investment. So we need to reflect this in our financial statements. To do this, what we've got to show is the valuation allowance for trading investments is going to be debited. This valuation allowance can have either a debit or credit balance depending on whether there was a gain or a loss, an unrealized gain or loss. In this situation, we had an unrealized gain. So because we have an unrealized gain, unrealized gains will increase on the credit side. So we know that the unrealized gain has to be credited here for the total amount of the gain, which we found was the combination of the unrealized gain for Apollo and the unrealized loss for heirs. The unrealized gain is credited because gains increase on the credit side. We have to have a debit to offset the credit, so we use what we call a valuation allowance for trading investments, and that account has to be debited at this balance sheet date. So something that they didn't ask you to do, but something I would like to talk to you about here, was at the end of the first year, we would prepare our financial statements. If there's an unrealized gain on trading securities, it is considered to be other revenue or other income on the income statement. So this unrealized gain would show up on our income statement for year one at $27,990. The valuation allowance will show up underneath the cost of the trading securities on the balance sheet. So you'd have the trading securities, the cost amount, plus the valuation allowance of $27,990 to give you the fair market value on the balance sheet date of the investments. We're going to show you a balance sheet for year two, but they did not ask you to do a balance sheet for year one. In year two, we purchased some Athena stock. So now we've got not only Apollo stock, but Air stock, but we've just bought some Athena stock. We bought 1,200 shares at $65 per share, plus a brokerage commission. When you buy shares of stock, the broker will charge you a commission. So what we do is we take the number of shares of stock that we purchased, multiply it by $65, and then add back to that total $120 commission. That gives you a total amount for the investment at $78,120. Our investment account is a current asset. Our assets are increasing here because we bought a new investment in Athena company stock for 1,200. We bought 1,200 shares of Athena stock as an investment. Again, the key here is it's telling you that it's a trading security. Because it tells me that it's trading securities, it's going to signal to me how I would show this on the financial statements. If they're trading securities, we're buying them to make a profit in dividends, to get some dividend revenue. We also are thinking that the market price of the share of the stock will either go up or it'll go down. And so we buy the stocks as an investment. We're hoping that the market price of the share of the stock will go up so we can make money off the sale of the stock, as we did in one of the earlier transactions. But there's a difference between a trading security and an available for sale security and a held to maturity type of investment. So pay attention to the terminology in the journal entry transaction so you'll know what to do with that particular type of investment. So investment in Athena Company is an asset account. It's considered to be a current asset account because we are planning to trade these securities regularly throughout the year whenever we want to. We're not planning to hold them for any length of time, but we did buy them as an investment. Hopefully we're going to make some money off of these investments. The cash account is credited for $78,120. On June 26th, we received an annual dividend of 21 cents per share on the Apollo stock. So when we receive a dividend, we're receiving cash. That dividend amount is going to be $882. We find that by taking the number of shares of Apollo stock that we own. We own 4,200 shares now at 21 cents each. So you multiply 21 cents times 4,200, and that will give you 882. We would debit our cash because our cash is increasing. Our dividend revenue is also increasing. We would credit it. On July 30th, we sold some of the Athena shares of stock that we originally purchased last year. We sold 480 shares of stock. Now, you might want to refer back to Athena Company stock, where we bought that stock. And the Athena Company stock that we bought came from transaction on March the 14th. We had 1,200 shares of Athena stock originally that we bought. So we only sold 480 shares of stock. We sold the stock for $60 a share, less the brokerage fee. So in order to find the cash amount that we would debit, we would take the number of shares that we sold times the selling price per share, which was $60, and then we're going to subtract out a brokerage fee. When we sell shares of stock, we're going to deduct the brokerage fee from the amount of cash that we would receive from the sale of the stock. That leaves us with $28,750 cash that we've received from the sale of stock. Then I would look at how much the stock originally cost us. And we're talking about 480 shares of stock. But to determine the stock cost per share, we would need to know the total amount that we had invested in Athena stock, which was $78,120. We would divide that by 1,200 shares, and that gives us the cost of our investment. $65.10 is the cost per share. Multiply the $65.10 cost per share times the 480 shares that you sold, and that will leave you with a credit to our asset account, the investment account, for the total cost of the shares that we sold, because the cash that we received was less than the cost of the shares of stock that we sold. There was a loss on the sale of investments. This loss on the sale of investments is an actual loss. The loss has happened, and so this loss on sale of investments would be increasing our losses. And if we were preparing an income statement, our loss would show up in the other revenue, expenses, and losses section of the income statement. This is an actual loss because the selling price was less than what we purchased the investment for. The difference between these two is a loss. It is also a plug figure here. So if you get lost in your transactions that you're working on Cengage, take the cash that you received from the sale and compare it to the cost of the stock that you sold. If the cost of the stock that you sold is more than the cash that you've received from the sale, there will be a loss, as in this case. Now we're at the December 31st transaction, where we have to value our trading securities at the fair market value so that our financial statements will be correct. So on December 31st, they've given us some information. The portfolio of trading securities, they said, cost $200,032, but had a fair value of $188,000 at the balance sheet date. Because there was an $188,000 value, it was less than what it cost us. So there's got to be a credit balance in the valuation allowance for trading investments at $12,032, which is $188,000 less the $200,332, which gives you a negative amount because it cost you more than what the fair value was. So this is really saying that there's an overall loss in this year at December 31st. Thus, the debit balance from the December 31st year one has to be adjusted to the new balance. That's very important information there. So we really started with what we had last year in the valuation allowance account. And from last year, we had $27,790. And I probably should have put here that this was December 31st, year one there, so you'll know what that is, where that came from. In other words, right here, our valuation allowance was debited for $27,990 at the end of last year. And so that's what we're starting with as the beginning balance this year. We also know from last year that we had an unrealized gain on the trading securities at $27,990. So what I did is I combined an account here. I hope this doesn't confuse you, to save some time and to hopefully help you to understand what's going on. There would be an unrealized gain account that would have been credited for $27,990 at December 31st of year one. but there would also be a loss account that would happen in this year because they're telling us that there is an overall loss in the cost of the trading securities because the fair market value is less than the cost of that. So what they've done basically is they've told you, because the difference between the fair market value and the cost is a loss amount, it's a negative amount, our allowance for trading investments would have to reflect that negative amount. And so do you see here where I've put in the balance at $12,032? What we don't know right now is the adjusting entry amount, but we do know that last year the valuation allowance had a debit balance. Now it's gone into a credit balance. We have to know how to get there. And the only way you can go from this positive amount down to a negative amount is to add the two of these together. That will give us $40,022, which is the total amount of the adjusting entry for the valuation allowance. Notice that the valuation allowance is credited for this amount. You could have also looked at it like this. We had a gain last year, an unrealized gain last year at the balance sheet date of $27,990. This year, we have gone to a loss. So in order to adjust the account to reflect a loss, we would have to add the two of these together to get the adjusting entry amount here. The loss would be a debit. Notice they used unrealized loss as the debit, and the valuation allowance is credited. This is exactly opposite of what happened last year, because last year at December 31st, we had a fair market value that was higher than the cost of our investments last year. So we would have reflected a gain. You might notice that these accounts are reversed out. So in other words, last year, our gain was credited. This year, our loss has to be debited. Last year, our allowance account, since it was a gain, was debited. Our valuation allowance was debited because there was a gain. But when there's a loss, it's got to be credited. So here we're recording it as a credit. And it's an overall amount that they're keeping up with. I want to emphasize to you that unrealized loss is an actual account that would end up on your income statement in other revenues, expenses, losses. It's an other item on the income statement. This valuation allowance will end up on your balance sheet. In the last part of this problem, they ask you to prepare a balance sheet. And they're asking you to prepare this balance sheet as of year 2. So make sure that you recognize that this is for year 2. This is what the balance sheet would look like. Since these are trading investments, they're set up as current assets. The trading investments would reflect the cost of those investments. Now you could go back and add up all of the investments that you had, your total portfolio of investments, the total group of investments amounted to a cost of $232,000. That's what they have given you in this problem. the valuation allowance for the balance sheet date ends up being a credit balance of $12,032, because this is a credit balance because our trading investments market value went below, the fair market value was below the cost. This has to be deducted. So notice here it says less valuation allowance. So these two combined give you the total fair market value of the trading investments, and that would be reflected on the balance sheet. For trading securities, you reflect them on the balance sheet at their fair market values, not at cost, at the fair market value, whatever that is at that particular time. Now, if this trading investment market value was more than the cost, this would have changed to add the valuation allowance, and there would have been a gain, an unrealized gain on the sale of investments in that case. But that's not what happened here, because what it cost us was less than our fair market value was less than what it cost us. There was a unrealized loss on those investments at year 2. Number 3 asks you how the unrealized gains or losses are going to be recorded on for the trading investments. And so I chose to show you year 1 and year 2. At the end of year 1, we had an unrealized gain. It would show up on the income statement in the other category. Other revenues, gains, expenses, and losses is where we would find this. For year 2, we had an unrealized loss this time. So the unrealized loss is also reflected in other gains, expenses, and losses on the income statement. Something that I failed to put on the income statement was also the dividend revenue that you had earned in these transactions would show up under this other section. So if you had dividends, it would also go on the income statement. But I think the question was about just unrealized gains and losses. How would they affect the income statement? But I want you to realize that the dividend revenue would also go under this category here. Dividend revenue would be added to the gains, and then it would be added back to income from operations to get the net income on the income statement. In this situation, our other revenue could consist of dividend revenue for year 2, as well as the unrealized loss. In that case, we would combine the revenue and the loss together and net them out, and whatever the net amount is, we would either add or subtract that to our income from operations on the income statement. So please read what I have written out here for you. You really need to understand some terminology before you attempt to do your problems. This is important information here that I'm giving you. So if I were you, I would print this off and study it, because it'll help you in the future. I'm going to stop sharing here, and then I'll meet with you again the next time. Bye-bye.